A Random Walk Down Wall Street Summary Part 1. The book A Random Walk Down Wall Street was the first book written by Burton G Malkiel that every investor should read once before indulging in any plunge. The book efficiently provides guidance about the life cycle of the investor. This week we sat down to go with some books that provide wise advice for the investment in the market. The book we selected was correlated to the modern classic Views about the Stock Investment. The Random Walk provides information about thousands of investors and can be described as the lucid mixture of the pragmatic views and theoretical concerns of business. The book deals with the readers and investors at any bracket of age. We liked the way the author described the market, and he mentioned it not predictable. In the cycles of stock, the run of luck is the misfortune for the ordinary gamblers. We agree with the author about investors are much better in the long run as compared to the speculators. The vast knowledge of the author explained the theory of firm foundation, intrinsic values for the stocks, dividends, discounting, and computed investment. The famous market manias were from the 17th century to the 19th century. The author mentioned 8 market manias, including Tulip Mania, South Sea Bubble, Nifty 50, the Japan Bubble, Roaring 80s, Roaring 20s, Soaring 60s, and Internet Bubble. In the book, we found some worthless investing theories that must be learned by the investors, and these theories were filters, Dow theory, relative strength, price volume, chart patterns, hemline indicators, Super Bowl indicators, odd lot theory, dogs of the Dow, January effect, weekend effect, and momentum investing. We agreed with the ranges of risk and securities. The diversification was the cause of low risk as mentioned by the author. He indexing strategy is the one I most highly recommend. Burton G Malkiel wrote this book A Random Walk Down Wall Street in 1973. This was a few years after the 20th century's first computer technology bubble popped. The latest edition comes after the dot-com bubble pop. This was the last of the 20th century's technology bubble. Investors hurt by the first bubble can be excused because they didn't have this book back then. But it's shocking how this era investors didn't heed to what Malkiel taught. This book is a must on every investor's shelf. And all investors must consult this book before taking an investment decision. Many investment books aren't reliable. It's because their authors are mainly selling the book. But Malkiel doesn't want to sell. Instead, he's a teacher having the discipline of a real financial economist. His writings are as rich as an expert journalist. We highly recommend this book A Random Walk Down Wall Street. Takeaways. It's not that tough to earn money in the share market. Investors often neglect the lessons of the past. It's tough to fight the emotional attraction of a likely bonus. In the end, the market will find real value or something near it. A stock can't have more value than the cash its investors make. Investors must benefit from tax-favored investment plans and savings. The ideal investment strategy is indexing. Many market variances, for example, the January effect, aren't playable. Avoid paying for stock more than its actual worth. The market is not predictable. But investors are better than speculators in the long run. A Random Walk Down Wall Street. Summary. Define a random walk. So, what does the saying stock prices are a random walk mean? Well, it says that short-term shifts in price are not predictable. This frustrates Wall Street professionals. It's because people pay them for their vast knowledge of the market moves. But the past is apparent. Investors who avoid predicting the market shifts do better than speculators. Hence, investment theories are critical. Two of the most key investment premises include firm foundation theory. There's an intrinsic value of stocks. This can be computed by discounting and adding future dividends. Warren Buffett and economist Irving Fisher swore by this theory. Castle in the air theory. Greater fool theory is its another name. As per this theory, successful investing depends on predicting the crowd's mood. Hence, an investment is worth anything people are ready to pay. And people are not very logical. There's enough proof to suggest that market acts illogically. Sometimes, prices are way over their real values. And sometimes the prices fall very low. Guessing such irrationality is tough. And profiting from this is more robust. History's most famous market manias. Tulip Mania. 17th century Holland suffered from this mania. The prices of tulip bulbs were insanely high. So much so that people even mortgaged their houses to buy them. The market came down in 1637. 1. South Sea bubble gripped 18th century UK. There was a craze for the attractive but worthless South Sea Company. This mania peaked and fell out in 1720. 2. Roaring Twenties. America's most crazy speculative events began in 1923. This ended with a crash in 1929, which led to the Great Depression. 3. Soaring 60s. The first tech stock bubble was during 1960s. Speculators ran toward any issue which had electronic in its name. This age also saw a speculative affair with concept stocks and MNCs. 4. Nifty 50. Some 50 solid growth stocks took Wall Street by storm. These included IBM, Avon, Xerox, and the likes. This trend sent their P/E ratios to double digits. But all this crashed. 5. Roaring 80s. A new issue of Mania came in 1983. The joy of the biotech craze and LBO boom got over in 1987. 6. The Japan bubble. The Imperial Palace in Tokyo had real estate worth more than all land in California. This was during some time in 1989. The Japanese share market had a value of 45% of the world's market. It crashed in 1990. 7. Internet bubble. The Nasdaq was led by high-tech firms in the late 90s. The market tripled before it crashed. 8. The market bubbles. A market bubble is nothing more than a Ponzi scheme. It booms till speculators are ready to put in cash, but fails as soon as cash stops coming in. In the 1990s, the internet boom was unique, but it involved unique neglect of basic investment logic. Also, there was a high level of corruption, of conflict of interest. The Chinese walls were separating analysts from investment bankers and brokers. These walls became leaky when the internet boom came. Analysts found that their jobs relied on offering unstable stocks good recommendations. Why? Because their companies' brokers could earn massive working for the analyzed firm. But firms hired companies that recommended their shares. Many internet firms didn't have any history. These firms weren't worthy investments when analyzed with old metrics. Hence, analysts came up with new parameters. The media drove speculation by converting these internet Start UPS into stars. Knowing the history and basics can help prevent massive losses of the popping bubbles. The passion of investors plays a part in share prices. But, still following the greater fool theory is dangerous. So, don't try to buy a shaky stock to sell it to a bigger fool because there may not be a bigger fool than you coming that way.